Shown on your screen here, the various sessions of the Forex listed on the left side of your screen. The Forex is not a building or an exchange, it's an electronic medium between two counterparties, buyers and sellers. The largest market is the London market. It opens up around 3 a.m. Eastern Time, closes around noon Eastern Time. Look at this. Pound dollar, nice swing at the London Open, 3:30 a.m. Eastern Time in this particular example. Look at this nice swing in price. This is where the money is, friend. That market opens and closes. USD CAD pair on this particular day. Look at this. A nice swing. Inverted hammer or shooting star right here. Tom DeMark trend line break. Right here, confirmed by MACD punching down through its trigger line. On this particular day, the USD Swissy, this happens to be the 5-minute chart. Look at this, a nice swing at the London close. We have a 1, 2, 3 top, 1, 2, 3, and down price goes. Here we have the dollar yen 15-minute chart, swing at the New York close on this particular day. Tom DeMark trend line break right here. New York close on this day on the euro pound. Look at this, we have an engulfing candle pattern right here, price swinging, a reversal in price. And of course, that's where you make money in this business, friend, is when you get a shift in price direction. Which pair should I trade? Buy the dips in an uptrend where the 50 and 200 EMAs are up on the daily, hourly, and 15-minute charts. Correspondingly, sell the rallies in a downtrend where the 50 and 200 EMAs are down on the daily, hourly, and 15-minute charts. Here's an example. I'm using the Aussie dollar in this particular trade example. I'm looking at the daily chart. Notice the 50 EMA above the 200 EMA, good angle and separation, the trend up. Looking at our charts top down, as I've talked about before, we move now to the 60-minute chart. 50 EMA, 200 EMA, good angle and separation, the trend up. That's 2 for 2. Now on to the 15-minute chart. 50 EMA, 200 EMA, good angle and separation. All trends end. That's a given. What you should look for is what's happening on the hourly chart. And when you see the 50 EMA starting to change its behavior, then you know that we're going to get a trend change on the hourly chart. This is the Kiwi New Zealand dollar paired with the US dollar. We have head and shoulders pattern complemented by negative divergence on MACD histogram to price cycling higher. The MACD histogram down here trending lower. That's negative divergence on the histogram to price. That's the second use of MACD. Where to buy and sell? You wouldn't drive a car down the highway without lines on the highway. You wouldn't land a plane on a runway without lines. You wouldn't play football on a field without lines. So why would you trade the Forex without lines? And typically what I do is I plot 9 pivot levels on my charts. As a matter of fact, these pivots have been incorporated in the Forex broker that we recommend. I've delineated 4 pivots in yellow. The midpoints are my own special levels. The area above the central pivot point has a sell bias. The area below the central pivot point has a buy bias. I typically plot my pivots on the 15-minute chart because in day trading you do your top-down analysis starting with the higher level charts, going through the 60-minute chart down to the 15-minute chart, and execute your trades on the 5-minute chart to get a good entry point with limited risk. But here's an example of scalping off the 5-minute chart using the pivots as support and resistance levels. So here are my 9 pivot levels, and I've indicated in yellow the 4 M levels, the midpoints that I use to calculate the sessions high and low. Let's have an example here. On this particular day for the euro, this is on the 15-minute chart, you can see that price reached after an uptrend continuation pattern for M4, the expected high on this particular day. Now, how did I know that the expected high for the euro on this day was M4? Well, let's have a look at these pivot levels over here. The close at midnight past was 15277. The open 24 hours earlier was 15194, meaning that the close obviously at midnight past was higher than the open 24 hours earlier, meaning that this particular day was going to be an M2, M4 day, meaning the expected low was going to be M2 and the expected high M4. And you can see that price reached through an uptrend continuation pattern for the expected high on the euro for this day, and it was achieved, wherein at which point price met resistance at M4. Don't forget, the area above the central pivot point has a sell status. Pound was certainly higher than the yen, and of course the difference between those two interest rates accumulated to the tune of $8,157.75. Added to the pip profit, the total profit on this trade was $22,067.59. That's pretty cool. $22,000 on a long trade on the pound yen during this period of time. Not too shabby. A different kind of example here. Pound dollar 15-minute chart. Midnight past. The close 19832. The open 24 hours earlier 19946. Meaning that this particular day for the pound had an expected low of M1 because the low at midnight was less than the open 24 hours earlier. If the close at midnight past is greater than the open 24 hours earlier, then we're in an M2, M4 day. In this particular day, we're in an M1, M4 day, meaning the expected low is M1. You can see how price cycled lower through a downtrend continuation pattern and met support at M1, the expected low for the day. Isn't that pretty cool? I showed you this chart earlier on in the presentation. There's a shooting star or inverted hammer. Now, we had the discussion earlier on about the Canadian dollar in recent memory, blowing through parity with the US dollar, reaching for the sky, getting up to 109, 110, and then, lo and behold, we had this shooting star or inverted hammer and price collapsed. I was short in here, made a lot of money in this move down on the Canadian dollar. This is a futures chart. Here's another one. Price rises in nice black and white inverted hammer, no tail or shadow or wick on this side, just up here, nice long tailed. I mean, this is what you really look for. Look at this. Rise in price, inverted hammer, kaboom. We have a Tom DeMark trendline break, confirmed by MACD punching down through its trigger line. Remember, that's one of the uses I use MACD for. Price collapses. And this happened at the London Open. So talk about a confluence of events. We got enough green lights here to keep us going for a long time. A downtrend continuation pattern looks exactly like this. Happens over and over and over again. Look at the trend. Down. Terminology. Leg 1, price equilibrium or consolidation, translation, traders chopping wood. Leg 2 down. Leg 2 is usually the same distance as leg 1. Once you recognize what's happening, A, B, C, D, you jump on board to the short side in this case right here. Look at price banging its head up against this moving average. This is the place to be going short in here because you know that leg 2 down is going to be about the same distance as leg 1. That's where you make your money. Downtrend reversal. No big surprise here. Look, the trend, the 200 EMA trending up. Price cycles lower. MACD waves higher. No big surprise that price was going to reverse in the form of a downtrend reversal pattern. Leg 1, price equilibrium or consolidation, leg 2 up. This is how you make money. After leg 1 consummates, you'd be going long in here, knowing that leg 2 is going to be about the same distance as leg 1. Another one, up, across, and up. Look at the attitude of the 200 EMA. Look at the attitude of the 50 EMA above the 200 EMA. Good angle and separation. Price rises, consolidates, MACD neutralizes back to the waterline, price takes off. Leg 2, usually the same distance as leg 1. A, B, C, D. This is where you're buying in here. And this is where you're getting out at the end of the run. exceeding the lower Bollinger Band, and again invariably price will pull within the bands and head to the other band. So going short here, going long here, an example of how you can scalp during stale periods of price movement.